I have a portfolio of long-term hold stocks that I don't trade. I buy and I just hold, including index funds. And then I have a part of my portfolio that I trade actively. So, and that's primarily the trade actively. I encourage folks that trade or that short-term invest that when you realize a profit, just take it.
Welcome to the Share the Wealth Show, where minority professionals can learn to escape the racial wealth gap and catapult themselves into abundance. Your host, Nicole Pendergrass, grew her net worth from being negative to multiple six figures. Join her on her investigative mission to expose secret strategies of the wealthy so we can all have the tools needed to build the life and legacy we were created to possess. Now it's time for the show.
Oh man, you guys are in for a treat. This episode that I speak with Travis Gibson is phenomenal. I don't even know where to start because we really discussed so much starting from the beginning of his journey. He actually grew up in a business and real estate oriented family. He talks about his father, how his father did and still does love walking around to his tenants and collecting rent checks instead of transitioning to automatic deposit, which is still crazy to me. But, do what you do. And he likes doing it. But then we transition to Travis's journey and what he learned as a child and growing up and watching his family in business and real estate, and how after graduating college, how he started acquiring properties. And the strategy that he used was actually super smart. Everyone, I don't even want to mention what it is because you will listen to it, but everyone gets this lump sum of money a certain time of the year. But instead of using it for vacation or whatever else, he used it to buy a property. And that's how he uses down payment for a property every year and just kept doing that year after year and accumulating assets. And then transitioning and getting into stocks and trading. And so he's not just in real estate, he's diversified into a bunch of different types of asset classes. And also at the end of the episode, we talk about the Dynasty Trust. Oh my gosh, you guys don't want to miss that part of the conversation. This episode, by the way, will definitely be split into two. We talked so long. We had so much information that he was sharing, and I just kept asking more and more questions because I just needed all the answers. And I think you guys are going to appreciate that. And you have to, I said I was going to tell you guys, you have to have your pen and paper ready. Don't listen to this haphazardly while you're walking around the house doing whatever. Have a pen and paper handy so that as soon as something is told to you, you can go and jot it down and then start implementing and digging in and contact Travis and figure out how he did what he did and how you can do it too. Just use the information. He is willing. He's an open book. He wants to help people. So with all of that said, let me tell you a little bit about his background. So he is the principal and founding member of a private equity investment firm called Freeman Equity, which has over 65 million in assets under management. He has over 20 years in both public and private equity markets. He has extensive experience investing in self-storage facilities, residential mortgage notes, mobile home parks, and single-family residential acquisitions, also office buildings and multifamily real estate syndications. So we didn't even talk about the mortgage notes and the mobile home parks. Oh my goodness. I feel like I need to get him back on already now. But he was coming from a background in software engineering, and he still is a software engineer full-time W-2 while he's doing all these other things. But he has a wealth of experience in defining project requirements and managing development teams for Fortune 500 companies such as EDS, ECMC, and Apple Finance. So without further ado, here is Mr. Travis Gibson. Hey, everyone. Welcome back again to the Share the Wealth Show. I am your host, Nicole Pendergrass, and this is the show where we talk about strategies to build, grow, and protect minority wealth. And today we have with us, you guys, this is just going to be crazy. I already can I have a feeling like the energy that we're going to get from today's conversation. And this guy is no joke. He doesn't pull his punches, literally and figuratively, because he actually does. What is it? I don't want to say martial arts because I know it's not that.
I do Brazilian jiu-jitsu.
Okay. I knew it was going to be something that I was going to missay or mislead, whatever. But yes, this is Mr. Travis Gibson, everyone. And he's going to come and bless us today with some conversations, some insights. Man, this guy does so much in the wealth building arena. He's in a lot of different avenues. And I know peripherally some of the things he's doing because we're part of the same group. But now I get to dig in and really like get the inside secrets. And you guys are just lucky enough to be listening to our conversation. Travis, welcome. Thank you for coming today.
Thank you for having me. I've been wanting to be on your pod for a while. You have the best guests. I always get something from the guests that you have on. So thank you for having me. I appreciate it.
Yeah, great. You know what? And thank you for that compliment. I really try to make sure that everyone gets something from each episode that they can actually take and implement, because I'm all about implementation, because the knowledge without using it is just wasted space in your brain. Right. Okay. So I gave a brief overview of your bio and kind of what we're going to talk about, which I don't know yet. And I'm so excited. But anyway, can you give us a rundown of kind of, I don't know where I want to go with this, but it's generally like, how were you raised without, going crazy, but like that mindset, what kind of family dynamics were you raised in, to like how that led you to what you're doing today, and what I'm really like the pivotal moments that kind of change your mindset or change your trajectory of what you're doing now.
Sure. I'll give you the Cliff Notes version. It's a long story, but I come from a family of small business owners. Originally, I'm from a small town in Michigan, a GM town named Saginaw, Michigan, right outside of Flint. And we migrated out to California in 1979. My parents opened up a nightclub here in Sacramento, and my parents actually ran that nightclub for almost 30 years. My parents still own the real estate. My mother is actually a realtor here in Sacramento still. Eventually, she says she's going to retire, but I don't think she ever will.
Mine either.
So I grew up in an environment where we just acquired single family properties. It's just kind of what we did. And my dad used to take me to collect rents. And it was one of the things he still enjoys it. I mean, he's in his 70s. He still enjoys going to his tenant's door and knocking on the door and collecting rent.
So he still collects rents in person?
Yes.
Electronic
Yes. No.
What?
I tried to get him. The only electronic payments he actually accepts are ACH from some Section 8 tenants that he has. Outside of that, it's one of his favorite activities is still going and knocking on tenants' doors and collecting rent. So,
oh no, I figured that out real quick, because I was living in the same building as them, and I was like, I don't want to go to the bank and have to cash this. Before I discovered deposit your check by your phone, which I guess, but no, I don't want that. I just wanted to be in my bank account. Okay, go ahead. I'm sorry.
No problem. So, I was taught early on to, you buy real estate. You don't wait to buy real estate. You buy real estate and wait. So after I graduated college, I was in a situation where, I was making pretty good money on my W-2, but I had no deductions at all, and I was getting murdered. California is horrible for taxes anyway, and it was bad back then.
What were you doing? What was your W-2 when you first graduated?
I was a software engineer. So, and that's my trade. Mm-hmm. So, my mother being a realtor was like, okay, you know what? Then you need some deductions, right? You need a place to stay anyway. Let's get you, let's buy you a house. So I bought a house and moved in it, and house hacked it before that was an actual term. Like I had 2 other rooms and I just rented them out. And I realized I'm staying there for free. They're paying my rent. So over the course of time, every year I would get this was my dad's method. When you get your tax return, you take that money and you use it as a down payment on another single family house. So that's pretty much that was the strategy that I followed for 20 years. Like literally I would just I would buy at least one single family a year, just like clockwork.
That is so smart. I'm sorry. My mind is already blown from that because, you know what? Because especially all right, where were you buying? Because your tax return was not that big that you were buying a single family house in California. Those are expensive. Because I'm in New York, so I know. I'm like, you got to go to another cheaper market.
Well, I'm going to date myself for a second. The first house I bought here in California, I paid $88,000.
Okay.
So, yeah. So, most of those properties 4 or 5x over the time that I held them. So what I was able to do is, I'd buy another one. And then I got married. And once I got married, obviously we started a family. I needed a bigger house. So we would buy a house, we'd have it 2 years, and then we'd buy another one and buy another one. So these were all owner occupied properties. And, I continued that until like 2008, where things got a little crazy for those that were in the market during that time. And particularly out here in California with stated income and these crazy adjustable loans. So like my portfolio just exploded at that point. But there was a lesson in that because the properties that I bought correctly, meaning I had really good debt, they cash flowed. Those properties I was able to hold on to even after the crash. But half my portfolio I lost in 2008. Lost it.
Okay, so I have to dig into that. And why did you lost them? Because the debt was bad? Like you did with some of those stated income loans, you were just buying stuff that even though you couldn't afford it with your income?
Yeah. Well, what was happening was once the interest rates started adjusting, the rents couldn't meet those mortgage payments anymore, right? So it's a situation where you start kind of figuring out, okay, these I want to hold on to, these, they got to go. So that was the position I was in. The properties that I bought prior to kind of that run up, that cash flow that I had, good fixed debt on, I had them until a year and a half ago when I sold them all and went into multifamily. That's a whole nother.
Yeah. So you did that mess up your credit when you?
Oh yeah, it was horrifying. Yeah, I mean, I'll tell you this.
You sound so happy about it.
Well, it was like going to college because believe me, it cost me enough. But it was a situation where I had to learn that lesson, and it was bad because us. We like to kind of flex a little bit, right? And I bought a big house in the Pocket area of Sacramento. It's an affluent area. I put a pool in, bought a new Mercedes. I was balling, like make no mistake about it. And I'll never forget the day that Lehman Brothers went under. I'm in the pool in the middle of the day. And I have the window open, the CNBC playing, and when they announced that, I'm like, oh, that doesn't sound good. That doesn't sound good. And within a month's time, everything had just started falling apart. So I went from like the highest of highs to like fighting for my financial life, like literally fighting. But the thing that it taught me was the properties, the assets that I acquired correctly weathered that storm. So it changed the way I looked at risk, and it changed the way that I looked at debt. So I'm happy about it now in 2022, but back in 2008, yeah, I wasn't happy. I was kind of depressed actually.
And you know what though, that like you're saying is good that you can actually look back at that and see and talk about what you learned from that lesson. And that's what you're supposed to view failures, quote unquote. They're really like just lessons. So now you're going to take that with you forever. You're going to teach that to your kids. That's going to be generational lessons, All right.
Oh,
so I interrupted you in your story. Keep going. This is great.
Okay. So to your earlier point about credit. Yeah, my credit was in bad shape. I mean, I had a bunch of short sales. And but the one thing that I did have is I had the ability to earn. I had a, pretty good paying W-2 job. And I still had the ability to identify a good deal when I saw it. So it took me 3 years or so to start kind of positioning myself. I saved up enough capital to begin to start trying to rebuild. And the market, I mean, literally, houses, that first house that I purchased that was 88,000 was worth 350 when all of this happened. But the prices dropped all the way back down to like 90,000. It was crazy. So, here I am thinking, oh yeah, I've made it. You know what? Yeah, no problem. And then all of a sudden, when you see your net worth get cut in half, 60, 70%, it's sobering. You're like, oh, okay, I better do something. So what I started doing though is my mother's, as I said, is a realtor, and she would just continue to shoot me, properties, and I'm like, oh, you know what? Okay, I found a lender that would, with my credit, that would, give me a mortgage. So I just started buying single families again. I mean, at rock bottom prices, and I was able to build, not quite as big as I was, but I was able to build up a pretty significant portfolio again of single family homes. But the whole time I couldn't stand being a landlord. I never liked it. And some people do. My old man does. So, the calls when I'm on vacation or in the middle of the night, and because my old man never believed in property management, he taught me, it was a waste of time, waste of money. You can collect your own rents. So I never had a property manager. So I just kind of had to, deal with that until, like I said, around 2019, a buddy of mine who actually inherited a pretty substantial portfolio from his parents, generational wealth. We'll talk about that in a second. He was telling me about multifamily. And I'm thinking, I don't have $5-10 million to be, buying an apartment building. I can't afford it. He was, no, you can invest with other people. I'm like, okay, well, it's kind of interesting. Had a little capital, put it into a deal. And I saw all of a sudden, like an ACH hit my account. I'm like, I started comparing the returns, the yield on my investment. I'm like, I could roll the equity that I have in those deals into multifamily, be getting a better return, all the tax advantages, and not have to deal with tenants. I'm like, okay, let me start building this out more. So that's what kind of led me into that whole multifamily realm.
Nice. I love that. And you know what? I think I got to that mindset about not wanting to be a landlord a while ago. I was like early in my journey, where, especially when I really dug into multifamily and joining these groups. But even before that, I was just like, I want to just get the equity from this property and just concentrate on asset management. Asset management is enough, working with a property manager on making sure everything's operating right. But having to deal with the actual tenants, like I know how to be, professional and hold in and like have my poker face, and I know how to deal with tough situations. But sometimes, man, they be pushing buttons. Do they not? Like, I'm trying here. Can you give me a break? Yeah. Like, not a slum landlord, but they don't care. And, they're not, I mean, I get it, but you got to pay your rent, man. That's it. That's all.
Yeah. Nicole, I'll tell you a very quick story. Out here in California, cannabis started becoming legal. There's a whole process of medicinal into like, full adult use.
Yeah.
And what was happening was folks were renting, they would rent houses, and they would go in and completely, rip out the electrical, run fans and lights. So I actually had a property where, and I should have known, but the thing about it is the tenant never gave me any problems, always paid their rent on time. It wasn't a problem until the city actually contacted me they had been contacted by the local electric company that they had super high power usage, and they suspected them of running a grow op in one of my rentals. So once that happened, I contacted the tenant and actually went by to do an inspection. And when I went by, they was gone. They were out of there. But they had completely, there was water damage, parts of the ceiling were tore out, it was a bunch of trash. And yeah, it was one of those things that, in 2017, 2018, that was really, really prevalent here in Sacramento, especially. So yeah, that was a learning experience for me for sure.
So what did you learn from that?
I learned that, you know what? It's important that you trust, but verify. And they, the tenant actually had done a fairly decent job at providing kind of a context for where he worked, where he was coming from, why he was moving there. I should have dug deeper. And because I had enough units where I was doing annual inspections, I just, you know what? They weren't giving me any problems. So I just didn't get by. I just didn't get by to do my annual inspections. And that's what happened.
How many years was that tenant in there?
Oh, they were in there a year and a half.
Oh, wow.
So I guess they were making pretty good money. Yeah. And like I said, always pay their rent on time. If I had known, maybe
they were smart. They was making their money. They wanted to make sure you didn't come by and give you no reason. And that's so easy. Like time goes by so quickly. I live 12 to 15 minute drive from my property, and I go over there as little as possible. Honestly, if there's not a problem, what's the point of me going over there? Yeah. So now I think it's still not as legal in New York. I think, is it? I don't know. Well, I need to check on that. Make sure I can learn those lessons. See, everybody learn lessons from people who have made these, errors and learn them already. Don't repeat them. Okay.
Annual inspections. Yep.
So we're talking still about your journey. What are you doing now? You're doing multifamily. We heard how you got introduced to multifamily, but you are now also active, right? So you're not just putting your capital passively into multifamily deals, which you could do, but what made you want to be active in it too?
I wanted to learn the actual business of multifamily. And it is, it's drastically different from your standard single family, property, just in terms of, dealing with the scale, but also dealing with the mechanics of essentially a commercial real estate asset. So because I was able to kind of see the value in multifamily, I thought, okay, well, great. Let me leverage my single family experience and my experience in real estate and actually start doing my own deals and GPing my own deals. So, there was a guy at Apple where I worked who eventually ended up leaving and starting his own company. But he and I were discussing things, and he was like, yeah, I got a deal in Kansas City and I'm looking for partners. If you're interested. I'm like, oh, that's perfect. It's exactly what I'm looking to do. So I was fortunate in that I was able to get in and learn as well as participate in a deal. I would hope that everybody gets this same opportunity, because I learned so much in that process from, just in terms of the legalities of structuring a syndication deal, in terms of, how to really do asset management, how to deal with property managers, the whole due diligence process. I was able to kind of get in and learn while I was actually in a deal, capital raising, investor relations, all of that. So that was early 2020, like February, I believe we closed that deal. And this was right around the time that the pandemic, actually struck too. Yeah. And I'll say this really quick. A lot of people were saying, oh, no, you shouldn't be investing. No, the world's going to end. And, because I had kind of been through an event, not similar. Similar, but not the same. I thought, no, I think things are going to work out. and there's opportunity here, and I wanted to take advantage.
Nice. I love that. And see, just thinking in an optimistic viewpoint, like there's been, things to happen throughout history that have been horrific, and that doesn't stop the world from turning, things are still going to keep going, and things will get better, and then they'll get worse again, and then they'll get better again. It's all cyclical, like life is cyclical. Okay. I know that you also have your take profits or don't branding.
Yeah.
What is that about?
Okay. I've been a stock trader and options I've been an options trader and a stock investor for 30 years. And one of the things I learned in that process is it's important that you manage greed. It's so easy to get sucked in, particularly when you start talking about equities, because, the money comes so fast. I say this all the time. It's easy to make money in the stock market. It's hard to keep it. So take profits or don't is the brainchild of that. Like I've been to the highest highs and the lowest lows with the market. I'll say this. I have a portfolio of long-term hold stocks that I don't trade. I buy and I just hold, including index funds. And then I have a part of my portfolio that I trade actively. So that's primarily the trade actively. I encourage folks that trade or that short-term invest that when you realize a profit, just take it, spend it, invest it. So what I encourage people to do is, and this is something that I did, particularly when we had the market run up in 2020 after the pandemic, I started taking my profits from stock investing and using that as additional capital to invest in multifamily deals, because I know, it's easy to make money in the stock market, hard to keep it. So to protect myself, I transitioned quite a bit of my stock profits into deals.
So how do you, I have so many questions. I'm not in the stock market like that. I just started buying index funds for my daughters, because I've just figured you buy a little bit, just dollar cost. I don't even look at it. I just buy a certain amount a month. And then when they're 20, their portfolio of stocks will just be something that extra that they have on top of the real estate.
Right.
But other than that, so like, how do you know when enough profit is enough profit? Like, are there metrics that you look at? I know, like you said, managing greed. And so I guess it's not really like the casinos, like you feel like you're up and you want a thing, but you want to step away, like cash out your chips. But at the same time, you like, oh, maybe if I do one more spin, so what metrics do you have that you look at? Is there a certain percent above your purchase price that you decide, okay, that's enough profit? Is there a certain return that you're looking at before you sell?
Yeah. I'll say this. It's important that you have rules in life, and certainly rules in trading. So regardless of what your rules are, I mean, they could be, you want to double your money, or you want to take profit at 25%. As long as you trade to those rules, there's a good chance that you can be successful. So for me, short-term trading, I'm looking, anywhere between 15 and 20% return within a specific window. And this podcast is not long enough for us to discuss option trading, so I won't. But needless to say, what I'm looking to do is to figure out the risk that I'm willing to take, and I'm also looking for the percent of profit that I want to see. So I in every trade that I do, I have a sell order for the top and a sell order for the stop. That protects you from that gambler's fallacy that it's so easy to kind of fall into, where you think, oh well, I know the market and this is going to happen. Nobody knows the market. No one. Anybody that says they do or is selling a course that say they do, I question why they're selling the course. Because if you really knew, you wouldn't have time to
sell a course.
Else. Yeah.
Do you have a course on trading?
And I'm going to tell you the reason why. I don't want to be responsible for anyone's loss. And the thing about it is my appetite for risk is going to be different than yours. You know, I don't know if you saw online, one of the things I was considering starting was a crypto fund. But when I started talking to folks, particularly, you know, people that I know well that have invested either in my real estate deals or just know me personally, I just wasn't comfortable with the idea that they could lose all their money. And, you know, anytime you're investing in a volatile asset like that, you could lose all your money. It's just a reality. So no, I will help anybody for free that asks, but no, I don't want to be your guru. Anyone.
That's not a guru. That's like just saving your time. Because what if 100 people listen to this and reach out to you and then you have no time to trade yourself. Now you made a promise that you'll help anybody who asks.
I will. The thing about it is everything you need to know is out there for free. If you're willing to actually take the effort, and if you're not, then, you know, then there's nothing I can do to help you.
Yeah, you don't want to waste time with tire kickers. You want people who are actually going to take action and take the advice that you're giving them. And you give a lot of information on your social media platforms when you're talking about your trades. You have a YouTube channel too, right?
Yeah, I need to start doing more video. It's, you know, it's just one of those things where, I mean, you know, with the podcast, you know, when you have, you know, you're actively working, you know, doing deals. I still have a W-2. You know, I manage software engineers for Apple. Between those things, and then, you know, I still have, you know, I have a family and family responsibilities as well. It's difficult, but no excuses. I'm going to be doing more videos. It is what I like to do. I just need to dedicate the time and just do it.
Okay. Yeah. You know what? And I honestly didn't know that you still had a W-2. I thought you were doing real estate full time because you're like always around. That and trading. Yeah. I don't know how you manage that, because I feel like if I was trading, I'd have to be looking at every second and I would get like, you know, my tunnel vision on my eyes, like, what's going on? So how often do you set certain hours of the day that you're actually trading and then certain hours of the day that you're doing real estate? Like, how do you balance it?
Well, what I do is, I don't know if you're familiar with the book of Hal Elrod's book, Miracle Morning, but I'm a huge proponent of that. So I get up at 5 o'clock every morning, and I have my morning routine of, you know, meditation and reflection and reading and exercise and journaling. And it helps me to kind of structure my day. And then from there, typically from a trading perspective, I trade from 6:30 till about 8:30, 9 o'clock. And normally by that time, I either made, you know, the profit I'm going to make for the day, or I'm just done trading, period. So, and, you know, from there I have, you know, I'm able to, you know, take investor calls and you know, be on asset management calls and look at deals and underwrite and all those things that we all do. And then of course, you know, my W-2.
Okay. Wow. All right. So that was great. Like, that was a lot of background information I didn't even really know about you. So let's talk more about the plight of our community and why more of us are not building wealth in a sustainable way. Like, information is out there. Yeah, it's not all easy to gather. Sometimes there's certain circles you won't know how the wealthy are really investing their money because you're not in that circle. And some things are just kind of private, you know, and I want to kind of do some investigations and dig out. Like, I just had a friend, one of my friends is a doctor, and she's really getting into investing more. And like, she got invited into this investment by one of the surgeons who makes $2 million a year annually. Like, she makes nowhere near that, but she's like, there's no way, and there's no way it's anything that you're investing in, I'm going to be able to invest in. But like, she was able to, but now like I have insight into this other little niche that I had no idea existed, but I'm not even close to being ready to invest in that kind of thing. Like, I'm working on it, but I just think there's just so much more information out there. And how can we really, you know, mine that information and and share it with our community so that people actually take action and feel like it's something that's attainable for them?
Yeah. Well, I mean, the first thing is you got to start where you are. So wherever that is, that's where you need to start. When you look at the statistics, I mean, they're sobering when you look at the difference between the median income of Black Americans versus everyone else. If you look at white families, for instance, the average Black family has a median net worth that is 15% of the median white family. 15%. And, there's estimates that by 2053, that the median household wealth for a Black family will actually be negative. Let that sink in for a minute, right? You work your whole life and you literally have nothing. Now, there's a lot of reasons for that, but the thing about it is, and this is what I tell folks that I talk to all the time. You have to get started. And at least for us as a community, we have to stop thinking that we need to buy a lotto ticket. We don't need to buy a lotto ticket. What we need to do is we need to invest what we have over time in cash flowing assets. So, everybody wants to buy, crypto and 1,000x their money. Everybody wants to do that. But when you don't have a whole lot of capital, it's important. I mean, Warren Buffett talks about, the very first rule of investing is don't lose money, right? So when you don't have a lot of money to invest, it's important that you're super diligent in choosing the best possible assets that you can from a risk standpoint, but also from a growth standpoint. So regardless to where anybody that's listening to this is, the first thing you need to do is figure out what your financial goals are, and then start extrapolating out from there. I mentioned earlier, when I got started investing in multifamily, I didn't have any idea that I could participate in buying an apartment. I had no idea. I thought that was only for the wealthy. But as I learned more, I realized that this is a vehicle that our community could really, we could gain so much from just participating in. I mean, it's not necessarily the community itself we have capital. It's how we're investing it. And it's our investment strategy that is problematic.
Yeah. I wouldn't even say how we're investing it. Sometimes it's just how we're spending it.
Well, that's a whole nother thing.
That's a whole nother thing. And I think that has some historical roots. All of it has historical roots. But the reason that we're trying to, or that we are spending money on things that are ridiculously expensive and all the name brand stuff and trying to flex, like you said, sometimes you want to flex and you're trying to show off, or keep up with other people that you admire, and like the whole Joneses thing. But that just stems from us coming from not having a lot and wanting to look the part. And even for life and death situations, even, back in the day, it was like, we're trying to look the part so that others wouldn't treat us even less than they were already treating us. So you could be allowed to get walked down the street without, with people at least ignoring you. That was like, I guess, a come up, so I don't know. Yeah. But there's so many reasons behind, historically why we still spend today, but now without just, because I understand the history behind it, but it makes me upset that like, we can't pull our mindset out of it. Like, and that's by design too. So I don't know what to think about it. It's like, sometimes when you think about the bigger picture of it, it just really does seem so helpless. It's like, how can we really change it? I saw an article the other day that like we had I forgot how much like in spending, billions in spending, but then our negative worth was like still, our net worth was still so much less because our money doesn't stay in our community. We're spending with everybody else, and everyone else is purposely making products for us. And so our dollars leave us and go to everyone else. So I don't know. I don't know.
We're consumers. We're not investors traditionally, but I mean, look at, current stats tell us 20% of African American families have a negative net worth right now, today, 20%. And, I'm getting older, I'm at a point now where, retirement is like on my mind. And realize this, almost half of African American families have less than $20,000 in retirement. 20,000, right? So when I say you got to start where you're at, it's important, when you're younger, and this is the big thing, and this is something that I've really tried to work on with not only my children, but also my family and pretty much anybody that wants to talk about it, is financial literacy is a huge component in this. Just learning how to manage your finances, and from there, how to invest it's pivotal, right? You want to buy assets that appreciate over time, not things that depreciate. But slowly but surely, like even if you're just even if you're putting away $100 a month, this is for folks that are maybe just getting started. You have to start someplace. You have to.
And that's kind of how I was because I started, I ruined my credit in college, and I had a negative net worth because I didn't buy anything that was an asset, and I had school loans, and so just moving and because I ruined my credit, like I had other debts, consumer debts, and just other things that it was supposed to be a money-making opportunity that I sucked at, and I didn't do anything with it. And so that just made me happy and more debt. And so it took me a long time of changing my financial mindset to like get out of debt and really work on that and get my credit score back up to a point, and then start slowly saving, like looking where I could purposefully decrease expenses. And in New York, your biggest expense is your housing, because I was looking at my expenses. I knew you have to decrease your expenses. Like if I don't think I can increase my income right now, I have to decrease my expenses. I'm like, okay, can I get rid of cable? It's like, all right, it's $30 a month. It's $50 a month. Like I'm not going to save that much by cutting out $50 a month. So I need something bigger. And what I had done is I had just moved into my own apartment, which is, that's the whole flex status symbol, like, especially in New York. Oh, you're an adult, you got your own spot now. You're not living with your parents, you're not living with roommates, you on your own, you can afford your own apartment, right? That was the status symbol. That was a flex. The first year I was there, the second year, like that year that I was there was when I started really having this mindset about where I can decrease my expenses. And I was like, I'm not moving. I really love my apartment. Like, I'm not like, I can still afford it. Let me look at all these other things that like $30 here, $50 here, whatever I could cut out. And then they send me the lease renewal, and it was a $75 rent increase. And I was like, come on, man. Like, I'm trying to decrease my expenses. I think that was the nail in the coffin for me that made me say, okay, you know what? I can't do it. I got to go find a room to rent. And that's what I did. And I went and looked, and I found an apartment I went from living by myself to living with 4 other women in an apartment, and like the living rooms have been turned into bedrooms. And that's just like how New York is. But I was able to cut my living costs in half. So that would help me save a significant amount. And that slowly led to me being able to buy my first multifamily and use FHA and borrow from my retirement account. So like just pulling from all these other resources, but you have to make those hard, uncomfortable decisions first, because otherwise you're just, if you don't want to get uncomfortable, you won't grow. Right.
The ability to defer gratification is a big part of any sound investment strategy. Do you want a new car? Yes. Do you need a new car is the question, right? Are you able to generate cash flow from an asset to pay for it? Whole nother question. But, starting off, just your ability to defer gratification and actually, now you don't save your way to wealth. Make no mistake about it. You invest your way to wealth. But saving has to be a component, especially when you're getting started. Like there's if you don't have the capital, there's no way to invest, right? So delayed gratification is huge.
Okay, guys, don't kill me, but I'm going to have to cut this episode short. This is too juicy, and we need to do this in a part 2. So stay tuned for the next episode that airs, and you can hear the rest of our conversation.
Did you love this episode of Share the Wealth Show? Be sure to connect with Nicole by following her on LinkedIn, Instagram, or Facebook. If you picked up any of the gems that were dropped by today's guest, make sure you not only put them in your bag, but if you know of someone who would benefit from this information, don't keep it to yourself. Share the wealth and make sure to leave us a rating and review. We'll see you for next week's episode. Subscribe so you'll be notified.